Hey everyone, welcome in to another daily editorial here on the KE Report. Happy to report that I'm chatting again with Jim Tassoni, CEO of Armor Wealth Strategies. I brought Tim on at the tail end of September, talked about markets, talked about his trading strategies, and received a lot of very positive feedback on the back of that interview. So now I'm getting Jim back on a more regular basis to talk markets. Jim, we were chatting off mic, and you mentioned a recent trade strategy that you had in the bond market as rates dropped quite a bit as the Fed was cutting rates, or everyone knew that the Fed was cutting rates. Really, it was May, June, July that rates continued to drop the whole way into the middle of September when the 10-year even got down to about just over 3.5%, let's say. Now it's rebounded quite quickly to over 4%, almost recalibrating what the Fed is going to do. Yes, continue to cut rates, but maybe not on the same aggressive path that markets were hoping for. Jim, what's your trade in the bond market then?
Yeah, absolutely. And thanks again for having me back, Corey. Love your show and love being a part of this. So I guess what we were talking about this back in mid-September 18th when the Fed started cutting rates. And we looked at the bond market as a whole, and we saw, like you said, there were a lot of investors out there who saw Fed's cutting rates. That's going to be bullish for all types of bond instruments. And we saw a lot of people positioning to get long the TLT or the longer term bonds. And we just thought with all the people leaning that way, that there may be a little bit of an offside trade to take advantage of. Because when we looked historically at the bond market, we said, okay, the implied Fed funds futures show us going down over the next 12 months to somewhere in the 2.75 to 3% rate on that Fed fund futures. And we said, we looked at back all the way to 1960 and tried to calculate what is the historical average spread between the short end of the curve and the longer end, the 10 and 20, 30-year bonds. And what we found was that spread normally is about 150 to 200 basis points or 1.5 to 2%. And so we said to ourselves, if the yield curve normalizes over the next 12 months and Fed funds does get down to that, let's say roughly 3%, we should be looking at a 10-year yield in the 4.5 to 5% range. And at the time of the first cut, the 10-year was trading at 3.65%. And we said, look, if this happens, we actually could see, although the front end is coming down, we could see the back end yields go higher and thus bond prices come lower. And so we took the opportunity actually to put a fairly sizable short on in the TLT, the long-term treasury bond ETF. We shorted that at 100.63. It's been a phenomenal trade for us. We actually took about half off today at 94.78. We're looking for a move to 93.70 to take another quarter off. And then we would actually hold the last quarter of that position. We think the 10-year could see yields as high as 4.65. That's our target on the 10-year yield right now. And that's where we'd hold that last piece short before we'd cover that final piece. So we think that was a trade that really was just mathematically oriented and just worked in terms of if we see the yield curve becoming more normalized in the coming months, it only made sense that this was going to play out the way it did.
Yeah, good call there, Jim. And the yield curve finally has normalized, and you finally have seen the steepening on the long end. And for about 2 years, it was the inverted yield curve. Do you have any thoughts on rate-sensitive sectors that may benefit by these higher rates, and that maybe the rates are going to stay higher for longer than the markets were expecting? Does that impact any sectors in your mind?
Well, we still continue to, and another call we've made that has been somewhat unpopular, but it's playing out fairly well, is we said even in mid-September that through the end of the year, we continued to like the technology sector, the Qs, more than, say, IWM or the small caps. We continued to like that trade, even though it had worked so well all year long. We said we would continue to be long the larger caps, the mega caps, especially if you're hedged against the small caps, the IWM, because we just continued to think that this may not play out exactly the way everybody was thinking it was going to. And we still liked a lot of the fundamentals. Our largest single position in our portfolio right now continues to be Meta. It's been a great stock and a great trade for us, and we continue to like that going forward. So we like that trade a lot. Another trade that is definitely in that rate sensitive area, and we're actually playing this one sort of in a pairs trade, is the real estate sector. And we're kind of being a little bit contrarian here in that we're actually long Simon Property Group against a hedged short of Ventas and Welltower. Reason for that is both fundamental and technical. We like the technical setup a lot better in Simon Property Group, but we also think that they're one of the largest owners and buyers of office and apartment real estate. We know those areas apartments have stabilized, taken a little bit of a step back, and offices have been essentially decimated. But Simon Property has a great balance sheet, a strong business, and they're the type of company that's going to be in a position to pick up these ideal properties when other operators have to let them go at fire sale prices. We like that a lot versus a Ventas or a Welltower, which is operating these senior housing, assisted living facilities. I know this has been a great place, and we know that there's an aging population and a lot of need for this, but there's also a lot of rhetoric in Washington right now around more regulation with regards to the pricing of these types of facilities, and more regulation is never a good thing for stocks. So we really like to incorporate that sort of pairs trade here, both in the real estate sector, but in very different areas of it. We think that's a nice trade to hedge out some of that interest rate risk, but also be in a more fundamentally advantageous area of that market right now.
So, Jim, let's also circle around to what we talked about in that first interview, some of the commodities, more specifically the gold miners. You made the comment that you were very bullish on gold miners back on September 20th when we chatted. Look, gold's continued to do well. The miners have actually done well too, but everyone is still waiting for almost more of a catch-up trade for the miners to catch up to those all-time high gold prices. Seeing a little bit of weakness in the gold stocks today. What's your trade here now?
Yeah, so we continue to be positive on the gold miners in general and this sector via the GDX or GDXJ. From the GDX perspective, when we look at the charts, we saw there was definitely some resistance, and it's become even more fortified up in that high that we made, that 41.95 to 42 area. We think that's an area that we've got to be able to break through and close above to take that next leg higher. In the meantime, we'd be looking for areas to possibly either add or begin a position if you're not currently invested. We actually added at 39 here today. We added to our position, I should say, at 39. We're trading about 38.69, 38.70 as we speak at this moment. So a little bit underwater on that trade, but we would definitely be wanting to continue to be long gold miners all the way down to, we think as long as we sort of stay above this 37.15, 37.10 area, you're still setting up very nicely to move above that 42 and then continue to the upside. If we lose 37, that's probably where I'd pull the ripcord again. Not trying to catch a falling knife. We think we're positioned nicely, and we think there's more upside given all of the geopolitical and different economic factors going on out there. But again, be cognizant, have a stop loss, know where you're going to get out before you get in, and that's sort of how we would set up this trade.
Well, Jim, just to follow up on GDX, it has been something a lot of the folks on our site have been watching just because a lot of people are very heavily invested in the precious metal sector and particularly the equities. And it has had a pattern of higher highs and higher lows throughout the course of most of this year, and it has been respecting, to some degree, the 50-day moving average. But a lot of people look at where the producers are inside of that GDX and where their margins are with all these record high gold prices, expecting them to have a pretty solid Q3, as that is a fundamental tailwind for the sector. Do you think it has the juice to finally get back above the peak we saw in 2020, which was around 45.78 in the GDX? Is there enough juice in this momentum trade? Since you said you're focused on momentum, do you think that there's enough momentum there?
I actually do. And I think this could be, I would expect this to be a very solid quarter. Now, it's always more about expectations than it is actual reports. So that's the one thing that I would tell investors to be cognizant of heading into these quarterly reports is what is the expectation and do we think we can exceed it? In my opinion, the answer is yes. I think that we continue to see really solid fundamentals. As you said, great margins for the underlying businesses inside of these ETFs and the underlying miners. And again, if you want to play this from a momentum standpoint, as opposed to an accumulation into a little bit of a consolidation, my area to watch now is 41.95. We get a close above that, I think we're heading back to those 2020 highs. That would be the area that I would watch. We need to get the close above 41.95.
So, Jim, to your point about expectations, then when we are heading into an earnings season, how do you balance that out? Because we look at what the stocks have done this quarter. Look, GDX is up about 13, 14% even after this pullback. It was up as much as 24% from the start of this quarter. What are the expectations in your eyes, and how good do the earnings need to be to satisfy those or exceed them?
So my expectations are for, again, I see profit margin expansions. I see continued increasing profit margins overall. And as far as expectations go, I think that we're going to continue to see beat and raises from these companies and these miners. I think that we've got a gold price that is very supportive of these companies pulling the yellow metal out of the earth and making very nice profits on the sale of that underlying commodities. So as far as that goes, I am, and Corey, you know this, I think that from a fundamental standpoint, we are definitely going to continue to see strength and continue to see guidance that is above street estimates. I truly believe that. But at the same time, I'll let price be my guide. I'll let price tell me when to continue to hold the trade and when to pull the ripcord, because me trying to speculate on what the underlying guidance might be or what the profit margins might be is a nice exercise, but at the end of the day, price will really tell you where the underlying stocks and ETFs are headed, and so that's what I'm really looking at.
Yeah, makes sense, Jim. Use the pricing as it presents itself on the chart in front of you. But of course, people like to look ahead and try to figure out where things are going. One question I have for you is the dollar has been relatively strong lately. You mentioned that you're viewing it through the terms of UUP, but obviously that's a huge counterbalance to the commodity sector. How do you see the dollar playing out moving forward?
Yeah, so we continue to think that right now, again, using price as our guide, if you look at the UUP ETF, 28.31 was a huge line in the sand. We bumped up against that. That was acting as major resistance for several months. And we closed decisively above that a few days ago on October 2nd. And from there, we've continued to just run higher. So that's something we're definitely paying attention to. We think the dollar right now, there's really no area of resistance. So we've got to pay attention to this because obviously, like you said, the counterbalance of a runaway dollar. And if the dollar continues to strengthen, that will have counter effects on all of the commodity markets. And so we're definitely keeping an eye on that. No position right now in the UUP. But again, that 28.31 level was a major point of resistance. Now we're kind of bumping back up into this 2870 area that was the next sort of band of potential resistance, but not strong resistance. We continue to see upside until otherwise proven wrong. And so we need to pay attention to that. I think the one thing that we all need to watch here is that we have a lot of uncertainty coming up in the next few weeks. And so when there's uncertainty, we tend to flee to various safe haven assets. So that's why we're watching the dollar, we're watching gold, and you also need to watch bonds. I mentioned we have that short on TLT, but we're paying attention to that because if we get a lot of uncertainty as we head into this election here in a few weeks, and if there's any more increased conflicts in the Middle East or anywhere else around the globe, we think that you've got to watch these safe haven assets because we think money could continue to flow into them.
This is interesting, Jim, because look at something like the VIX is over 20 right now. It's staying relatively elevated as the S&P did just hit some recent all-time highs, but we are hearing from a lot of our generalist commentators that they are a bit more worried about Q4, even more worried about the beginning of next year. Are you worried of a major market pullback or really fear coming into the sector?
Yeah, I think as far as a major market pullback goes, it's difficult right now for me to make that call. I think there are definitely reasons to be cautious, as I stated, but using price as my guide and not trying to guess what's going to happen, I think anyone who has tried to play the game of, the market's overvalued, valuations are stretched, there's all these concerns, they've missed out on a historic rally over the last, 18 months. And so I think for me, I would rather continue to be long risk assets until the market proves otherwise. And so, for instance, if you're looking at the broad market, the S&P 500, if you will, the SPY, right now, we've been long. I can't even remember the last time we were out of that market, but I think you've still got a lot. We just crossed another resistance line for us at 568.69. Every time there's any type of resistance forming, we bump up against it, and then we go through it. When you're seeing that kind of market action, I find it very difficult to try to make a guess as to when that's going to stop. I would rather just keep trailing my stops, have my areas of interest where right now I wouldn't get concerned about SPY until we saw a close below 544. And I know that's quite a ways away, but I believe in giving myself that kind of room. And that's why we've been able to be successful for ourselves and our investors, holding these positions for the long term when there's been a lot of noise over the last couple years about getting out of the markets at various points. But if you stayed long, you definitely were rewarded.
Oh, absolutely. Don't fight the trend. Hey, as much as you can on the internet, man, oh man, read every reason to sell out of the market and the market's going to crash. But look at how well it's performed in the last couple of years, especially after that COVID crash. Look, we will get market corrections. Those are natural. We will have market crashes too, but always saying that one's going to come. It's a tough call, and it can be the wrong side of the trade for a lot of the time. But Jim, great chatting with you. Again, Jim Tassoni, CEO of Armor Wealth Strategies. Click that link in the show notes to visit Armor Wealth Strategies website, and I'll be having Jim back on the show in another couple of weeks. So Jim, thanks again for your time today.
Thanks, Corey. Appreciate it.